Welcome. In the world of investing, how do you get ready for, well, everything? How do you prepare for both a siege and a launch? Today, we're going to dive deep into building a portfolio for 2026 that does exactly that. Think of it as part fortress and part rocket ship, blending the rock-solid security of gold with the just insane potential of silver. Let's get into it. So let's just lay it all out there. This is the core challenge we're all facing, right? We've got inflation worries, geopolitical stuff flaring up everywhere, and massive technological shifts happening all at once. So how do you protect what you have while still positioning yourself for some serious explosive growth? It's the ultimate balancing act, playing defense and offense at the exact same time. And here's our roadmap for today. First, we'll hit the big picture, what we're calling the 2026 metals supercycle. Then we'll zoom in on our two star players, gold and silver, and the different roles they play. After that, we get into the real nuts and bolts, the how. We'll talk about the insane leverage you can get from miners, I'll give you a stock picking checklist, and then we'll put it all together and construct a blended portfolio. All right, first up, let's set the stage. To really get why this strategy is so powerful for 2026, we have to zoom way out and look at the massive economic forces that are at play. This isn't just about little market trends. This is about a fundamental shift in how the entire world works. This quote from macro strategist David Hunter really just nails it. His whole thesis is that we're basically at the end of this 40-year market cycle, and what's coming next is a huge, once-in-a-generation super cycle for commodities. So think of it like a global reindustrialization that is going to demand an absolutely incredible amount of raw materials. Now, the key thing here is that these forces aren't happening one by one. They are all converging at the exact same time. It's a perfect storm. I mean, look at this. You've got these persistent inflationary pressures from all the global debt, which makes real, tangible assets way more attractive. You've got geopolitical instability pushing people towards safety. You've got this massive industrial reshoring trend that needs a ton of commodities to rebuild supply chains. And smack dab in the middle of all of it, a structural supply deficit in silver, which, by the way, the Silver Institute says is now in its 6th straight year. These things are all feeding off each other. So we get the why behind hard assets now. Let's dig into the what. Our entire strategy is built on two specific metals, the king, gold, and its much more volatile cousin, silver. And they each play a totally distinct but complementary role in our portfolio. We call this the barbell strategy, and you can see it right here. On one end of the barbell, you've got your anchor, gold. It's your classic safe haven, right? It gives you stability when the markets go crazy. It's the defensive core of the whole operation. And then on the other end, you have the rocket fuel, silver. As analysts have famously called it, silver is gold on steroids. It is your accelerator for explosive, face-melting growth. And this chart, this shows exactly why silver has that kind of explosive potential. It's because it has this dual identity. You can see here, about 45% of its demand is monetary. That's investors treating it like gold, a store of value. But more than half, 55%, is industrial. And we're not talking about just any old industry. We're talking about the most critical growth sectors of our time: AI data centers, electric vehicles, solar panels. This industrial backbone gives silver a demand floor that gold just doesn't have. So how do we actually track this accelerator phase in real time? Well, the key metric to watch is the gold to silver ratio. It's simple. It just tells you how many ounces of silver it takes to buy 1 ounce of gold. As this chart shows, it peaked way up at 120 to 1 back in 2025. That meant gold was incredibly expensive compared to silver. But since then, it has just collapsed down to a 15-year low. And what that tells us is that silver has been dramatically outperforming gold. And a lot of analysts think it still has a long, long way to run to get back to historical norms. Okay, so we've got the big macro story. And we've picked our metals, but how do we amplify our returns? How do we really get the most bang for our buck here? The answer isn't just buying the physical metal. No, it's investing in the companies that dig it out of the ground. That is where you find some truly incredible leverage. Now, before we see that leverage in action, you have to understand one critical metric. It's called the all-in sustaining cost, or AISC. Put simply, this is the break-even price for a miner. It includes everything: the cost of digging, processing, paying people, maintaining the mine, you name it. A company with a low AISC is efficient, it's profitable, and it's tough, even if metal prices take a dip. Honestly, it's the single most important number you need to know when you're looking at a mining stock. This is where the magic happens. This is operational leverage, and it's amazing. Just follow the math here. Let's say a miner's all-in cost, their AISC, is fixed at $25 an ounce. If silver's trading at $30, they make a $5 profit. Okay, fine. But watch what happens if silver's price jumps 150% to $75. Their costs are still fixed at $25. Suddenly, their profit margin explodes from $5 to $50. That is a 1,000% increase in profit from just a 150% move in the metal. This is the leverage multiplier, and it's why these mining stocks can deliver such mind-blowing returns in a bull market. Now, that leverage is incredibly powerful, but it's also a double-edged sword. Badly run companies can go to zero just as fast. So now that we get the potential, let's build ourselves a disciplined checklist to help us separate the high-quality winners from all the speculative gambles out there. Think of this as your quality filter, and sticking to it is absolutely crucial. First, like we said, a low AISC is non-negotiable. It's all about profitability. Second, we want to see high free cash flow. That's proof that it's a healthy, self-sustaining business. Third, jurisdiction is huge. We want miners in stable places like North America and Finland to keep political risk low. Fourth, a quality resource base means they've got plenty of metal in the ground for the long haul. Fifth, a strong project pipeline shows us where future growth is coming from. And finally, you need disciplined management that has a proven track record of making smart decisions with money.
Okay, so we've got the theory, we've got the macro view, and we have our quality checklist. Now let's finally put it all into practice. Here's what a real-world blended portfolio could actually look like, using a mix of individual stocks and ETFs. So this table shows how different companies can fill different roles in the portfolio. For your low-risk core, you might have a big gold producer like Agnico Eagle. Then you've got a company like Wheaton Precious Metals, which is a streaming company. They don't even mine themselves. They just finance other miners in exchange for cheap metal later, which gives them super stable cash flow. Then on the accelerator side, Hecla Mining gives you that pure-play silver exposure, while First Majestic is famous for having high operational leverage to the silver price itself. Now, you don't have to go out and pick individual stocks if you don't want to. You can also use ETFs. And the trade-off is pretty simple. With individual stocks, you can really concentrate your money in what you think are the absolute best-in-class companies. That gives you a higher potential reward, but it also means more risk if one of those companies messes up. ETFs, on the other hand, give you instant diversification across a whole basket of mining stocks. It spreads your risk out, but it also means you're going to own the mediocre companies right along with the great ones. And you can use ETFs to build this entire portfolio. For your defensive fortress, GDX holds all the big, established gold miners. For your offensive attack, SIL holds the major silver producers, while SILJ, that one focuses on the junior miners. Now, these are smaller, higher-risk companies, but they have the most explosive potential. And then there's SLV, which is totally different. It doesn't hold stocks at all. It holds actual physical silver bars in a vault. This gives you direct price exposure without any of the miner leverage. So putting it all together, here's one way you could structure this thing. You could put a 40% core in senior gold miners. That's our defensive stability. Then we add 30% in established silver miners to capture that industrial demand story. For our high-growth rocket ship component, we allocate an aggressive 20% to the junior miners. Those are the stocks that are most sensitive to a rising silver price. And finally, a little 10% slice in a physical trust gives us a pure, unleveraged hedge against everything. And that's really the whole idea in a nutshell. By blending the defensive anchor of gold with the offensive firepower of silver, you create a truly balanced portfolio. It's a structure that's designed to weather uncertainty while being perfectly positioned for the commodity supercycle that we see playing out right now. And just to give you a sense of the kind of potential we're talking about here, just look at the wild range of analyst price targets for silver. You've got conservative cases down around $80, but then you have respected strategists calling for $180, $250, even over $300 an ounce, all driven by that gold to silver ratio getting squeezed. Now, of course, these are not guarantees, but it just shows you the enormous scale of the repricing that many experts believe is on the table. And that really brings us to our final thought. We've built this balanced strategy all around silver's dual nature. But the future will likely be driven by one of those forces more than the other. So which is it going to be? Will it be the relentless, grinding demand from the green energy and AI revolutions that pushes silver to new highs? Or will it be a full-blown crisis of confidence in our currencies that causes a panicked rush into monetary metals? That's the big question to ponder as we watch this all unfold. Thanks for joining me.